Um, Following September's officially driven third quarter slam down, the sheer scale of this paper to physical disconnect has reached really untenable levels. And at the margin, again, is undoubtedly going to force Western paper market deleveraging. Now, outflows of physical gold underpinning the fractional amount of US-centric gold are unseen by the blinkered speculators who are just auto-selling fiat gold against a rising dollar simply by an algorithm that says buy dollar, which is fiat, sell gold, which is fiat gold, because it's not real gold. So it's a simple little game.
The current decline in gold prices, attributed to leveraged paper market activities, has ignited a burgeoning interest in physical gold. This phenomenon carries profound implications for the commodity trade market. Gold prices have continued their downward trajectory, with expectations of the U.S. central bank maintaining higher interest rates for an extended period, contributing to monthly and quarterly declines. Central banks manipulate gold prices through speculative selling, keeping them artificially low. Despite this, rising retail demand and strategic central bank actions are gradually tightening the physical gold market, hinting at an upcoming reevaluation of gold prices. Andrew Maguire believes that there is an alarming disconnect between the paper and physical gold markets, and this situation has reached unsustainable levels, particularly after the third quarter market events. He points out that the outflows of physical gold supporting the fractional reserves of the U.S.-centric gold market are largely unnoticed by speculators who automatically sell gold when the dollar rises, driven by algorithmic trading. The recent surge in the dollar during the third quarter, accompanied by rising yields, triggered a significant capitulation of long positions in the paper gold market, simultaneously giving rise to a surge in short bets. This heightened volatility within the paper market has resulted in a pronounced disparity between paper and physical gold prices. Additionally, central banks initiating NSFR delivery for spot gold positions are forcing a correction in speculative long positions, particularly those betting against the dollar and shorting gold. While it benefits the Federal Reserve with short covering, non-sticky speculators' exit may pressure liquidity providers with long positions, potentially requiring physical gold delivery. This complex situation is worsened by short speculators vulnerable to market fluctuations, potentially leading to a short squeeze. We will now bring you clips from Andrew Maguire's interview with Kinesis Money. But before we do, if you want more videos like this, hit the subscribe button and turn on the notification bell for more updates. Thank you, and enjoy the video.
Following September's officially driven third quarter slam down, the sheer scale of this paper to physical disconnect has reached really untenable levels. The end of the third quarter ramp in the dollar and the yields has driven a mass capitulation of paper market long bets, paper gold bets, and ramped up short bets, i.e. people who are saying, hey, I bet lower and I'll just chase this dot down. They are driving the COMEX paper to physical disconnect to absolute extremes. And as we mentioned earlier, the ramp in treasury yields alongside global yields hitting record highs has driven speculators to race into cash and the dollar, reaching November 30, which the dollar has reached these November 30th highs. And we saw that happening overnight. And to provide context, on November the 30th, gold futures were trading at 1,758. Although it bottomed in the 1,600s in November, actually on the 30th, this is where, and we're trying to apples, dollar price to where gold was at that point, 1,758. Illustrating, though, the paper market bleed out of this inversely correlated algo. And also, we were benchmarking silver at 21,355 on November the 30th. So just to provide a little context. And following the end of week meetings with first tier liquidity providers over the weekend and again last night, despite hawkish Fed spin driving yields and the dollar index higher, the consensus is that the rise in bond yields is perceived to actually be taking pressure off the Fed's current hawkish spin. So really, again, just automated selling based on headlines and really no one looking any deeper. And as a wall of long, this is important, a wall of long T+2 central bank spot gold positions will now have commenced the NSFR delivery process. And the spec long clean out has led by spec long clean out and led by the nose, these long dollar short gold positioning has provided the Fed some very large short cover into this raid. But while very short term, these official short bets have been largely squared off inside the non-delivery COMEX exchange against the specs, on the other side of this trade, liquidity providers holding offsetting longs in the spot delivery markets will be forced to deliver physical gold against the spillover of very large unwind of leveraged sales. Now, with non-sticky speculators largely capitulated. Now, remember, there are some sticky speculators, commodity trading advisors, who recognize that even paper gold has become a first-tier asset class. So really, they don't get rinsed. So it actually reduces the amount of bandwidth that the insiders get to play with. And even though they've borrowed these positions from the house, they're doing it's a function. They are actually a hedging function. So they're not easy to rinse out. But those with the non-sticky specs capitulated, all their longs are gone. The downside is being driven by fresh dollar index backed naked short spec positions, which are vulnerable to the house who are betting long against them. Insiders exposed to this offsetting imminent T+2 delivery obligation will be looking to buy back what they can to offset the resulting unwind of paper market leverage, while momentums will likely try and chase the paper gold lower. November capitulation limits are pretty much evident, and footprints evidence insiders are already positioning long.
Andrew highlights two significant, often overlooked factors that could substantially impact the gold market. The first factor is the Russian gold for oil trade, and the second is a revisitation of the Chinese gold trade. These two drivers can potentially compel a revaluation of gold prices before market dynamics force a COMEX default. The Russian gold for oil trade creates a lucrative arbitrage opportunity through Moscow futures contracts. Despite some frictional costs, it offers substantial discounts on oil, making it enticing for participating nations. This trade results in a notable outflow of gold from the global market, particularly from Russia, bypassing international sanctions. Russia is set to purchase foreign currency and gold due to a surge in energy revenue exceeding budget targets. Since halting purchases in January 2022 and suspending the program after the Ukraine invasion the following month, the finance ministry has only sold foreign currency this year as part of a revamped fiscal mechanism. In the current situation, insiders are amassing physical gold. Central and bullion banks are capitalizing on speculator-induced price declines to bolster their reserves. Maguire points out that the paper gold sell-off surpasses the balance between leveraged paper market dynamics and the yet-to-be-realized force of unleveraged physical gold buyers. This shift in market dynamics hints at a potential gold revaluation in response to these underlying factors.
And there are two real unfactored physical gold drivers that will force the house to revalue gold before the market causes a COMEX default. Now, one is the Russia oil for gold barter trade, and the other is for a revisit to the China gold trade that we covered in the spring, which is completely off the radar. That while the Moscow futures contracts are physically settled, COMEX-driven gold is paper settled and is not deliverable. And therein lays a massive paper-to-physical arbitrage opportunity for friendly countries easily able to access the increasingly liquid oil for bullion trade, which, even accounting for friction, essentially provides about over a $30 discount for oil, which can be arbitraged right back into the global oil markets. This is a hugely attractive trade. And in the meantime, what it's doing is sucking bullion out of the system. Now, the gold for oil trade effectively circumvents Russian sanctions. But our focus is that at the margin, and this is so important when you have leverage against unleverage, these global bullion outflows flowing into Russia are draining sufficient physical gold from the wholesale global markets to seriously deplete immediately deliverable global bullion supplies at current prices. That is, I mean, this is the point. There'll be gold available at some price, at a hell of a lot higher price. But you start to play games with the paper price, very little comes on offer. And interestingly, at an end of quarter meeting over the weekend, it was indicated by one of our extremely well-connected first-tier liquidity providers that the current counterintuitive gold sell-off that began on the first trading day of September was very likely an official pushback against this extremely disruptive, sanction-busting oil for gold trade, and a factor that has driven the most aggressive official paper gold market intervention since gold bottomed at $1,618 back in November 2022. Now, in fact, liquidity providers see a very close parallel to when the Fed was forced to capitulate the March to November paper gold sanctions pushback. If you remember, that sell-off started as soon as Russia gave a grand price for gold for this oil trade, for the energy trade. And immediately we saw this massive sell-off. And it capitulated in November. And guess what? By then, every single bullion bank, including the Bank of International Settlements, as you just rightly said, Shane, went long physical gold against the Fed, evidencing gold bottoming out, in fact, at $1,618. Now, every single insider is accruing physical gold. Every speculator-induced gold rinse downwards is being capitalized on by central banks and bullion banks for their own book. The intensity of the paper gold sell-off has far exceeded the balance between where the leveraged paper market runs head-on into an as yet unrealized, unleveraged competing physical gold buyer.
The current divergence between paper and physical gold markets will likely lead to a significant reevaluation of gold prices soon, potentially triggering a seismic shift in the global gold trade landscape. How might the divergence between paper and physical gold markets impact the future of gold prices? Share your observations in the comments section below. Also, ensure you like this video, subscribe to the channel, and turn on post notifications for more videos like this. Thanks for watching.